I'd like to thank everybody for joining me today. Today, I want to talk about how we design life insurance policies. And I think the best thing to do with life insurance, I see this out there, life insurance for a lot of people, it's sold as a commodity. And we know that life insurance is customizable based on the goals of our clients. So we need to come from this goal-based approach to make sure that we're getting the right design for our clients. So if you start looking at, life insurance and think about it as a planning tool. And as a planning tool, we can start looking at, are we doing tax planning with this tool? Are we doing estate planning, retirement planning, business planning? All of these different planning areas, that missing piece that really sets that planning apart from what others are doing, a lot of times is the life insurance. But there again, if the life insurance isn't designed the right way, it's not going to be that piece that fits perfectly to make sure our client's planning is done complete and the right way. When you look at life insurance, one of the things that happens out there is, how are we covering the cost of this policy? Well, if we want to maximize the death benefit of a life insurance policy, what we're looking at is getting enough premium in there to pay the cost of the policy with very little or no cash value. Now, if we went out and did a poll of most potential clients out there, they think this is how life insurance really is designed and sold, and especially as a commodity. Maximum death benefit, minimum or no cash value, just enough premium in there to make sure the cost is covered. Well, if we're maximizing the death benefit, we also want to look at, are we trying to get guaranteed death benefit or just working off the non-guaranteed assumptions? But there again, if we want to maximize the death benefit, getting enough premium in there, very little cash value, but making sure the policy performs the way that we want. The flip side of that is maximizing our cash value. Well, if we're maximizing the cash value, we want to minimize our expenses, and therefore we're going to get right to that modified endowment contract line, stuff as much premium in there as possible without violating the MAcc line so that we get maximum cash growth. Well, that gets us into starting the design of our policy. So death benefit, cash value, making sure we account for the cost. But now when we start looking at this, we want to make sure our clients understand the other benefits of life insurance. Well, number one, it's an income tax-free death benefit. Remember, income tax-free. If we want it estate tax-free, we can get there, but it takes some extra planning. But by definition, death benefit is not estate tax-free unless we use a trust or other planning. We get income tax-free growth on the cash value and distribution of the cash value if we're planning it properly. There again, is that a goal of this policy? If it is, we want to make sure it's a non-MAcc policy. If we don't care, we can MAcc the policy and really get good cash growth, but growth and distribution the distribution of cash value is going to be taxable. This is a good part. We see a lot of planning using life insurance to plan for retirement benefit. The beauty of this is we can access that death benefit, without a penalty before age 59 and a half. And if they don't need the cash value, we don't have required minimum distributions that are going to force us to take that cash value out. So we don't need the cash, great, pass it on to the kids as an income tax-free death benefit. And this is a big one. There's no limitations on contribution amounts. If we're working with a high income client, a high net worth client, a lot of times they're looking at places, how can I get more money for my retirement planning? Well, unless they're doing something more than a 401k in their business, they need other places to put it. Well, other qualified plans may or may not make sense in their business, but life insurance, we can design it as that Roth comparison and they can put in as much money as they want as long as they can qualify for the death benefit. So it creates some opportunities. Finally, with designing the policy, we can add riders. And these riders are, lifetime income riders, long-term care riders, chronic illness riders. All of these riders can add more to our clients' planning. And so if that's the goal of the policy, make sure we've designed it properly, or we can add it as that what if benefit just in case, things in retirement years don't go as planned from a health perspective. So all these benefits of life insurance, if we're using it properly, just allow us more tools to get to the right design for our client. Now, as we're designing our policies, we want to know who should be the owner and beneficiary of that policy. If you start looking at it, we can use the policies inside of a business for buy-sell agreements. There again, if we're doing a buy-sell agreement, the owner and beneficiary is very key. Is the business the beneficiary and owner of that policy? Or in a cross-purchase buy-sell, we would want the owners to be the owners and beneficiaries of each other's policy. We can create key person benefits and executive benefits with the life insurance. So as we're designing it, if the goal is to create key person benefits, well, we want that business to be the owner and beneficiary of that policy. That key person dies or leaves, we need to have access to that money now to keep the business going the way it should. If it's an executive benefit, well, now we have to look, is it, a split dollar where we may have different owners and payers and beneficiaries? Is it an executive bonus where the owner is the employees, the payer is going to be the business? So we've got flexibility here. We just need to know, what are we trying to accomplish? In the personal setting, the owner and beneficiary makes a lot of difference in the estate planning world. Do we want that death benefit outside of the estate tax? Do we also want that away from creditors? If so, the owner better be somebody other than our individual client. Maybe we wanted an LLC. Maybe we wanted it in an irrevocable trust, which brings other elements into the plan. From the personal side, income replacement. Well, it's a great way to have, that benefit if something happens to the spouse that is the income generator in the marriage. We can have a policy to have that. There again, owner and beneficiary makes sense. And finally, on the living benefits, what I do see as a problem here, we want the benefit personally, but somebody has now put the policy inside of an irrevocable trust. Well, if that's an indemnity policy, we've got a problem. And if it's a reimbursement policy, we've got a problem unless we've set up the trust correctly with the right kind of policy. And then, of course, if we want cash value, do we want that personally? Do we want it in the business? We want to make sure the owner is in the right spot if we're looking at it for cash access, what if planning. Now, I come to the next part. Who should pay the premium? Well, of course, when we're paying the premium, we can have an individual, a business, a trust. All of this is set up to where we need to know who's writing that check, so that as we're designing this policy, there again, goal-based design. Well, if I want this as an individual benefit, okay, I'm okay having the individual pay it. If I want it coming from the business, even though it's not tax deductible in most cases, I may want the business writing that check for business purposes, or I want it completely out of the state with no IRS issues. So I've moved money into the trust and actually have the trust pay the premium. There again, these are all key to getting to the right result. Finally, premium finance, using other people's money and having the bank write the premium check. There again, good result if that's what our client needs. So as you start looking at this, as we're designing life insurance, it comes down to completing the puzzle for our client. And all of our planning can be tied together in a lot of planning cases by making sure the life insurance is properly designed, properly owned, and is being paid by the person or entity that should be paying for those premiums. I appreciate everybody getting on. If you have questions, feel free to reach out. If not, we'll talk again next week. Thank you.